Welcome back to Investing Talk Podcast.
Today, we are dissecting a company that has been absolutely tearing up the charts. Has left a lot of investors wondering, did I miss the boat or is this ship just leaving the harbor?
Yeah.
We are talking about Micron technology, and the narrative right now is it's fascinating. We are standing at this massive crossroads in the semiconductor industry.
Right.
The big question on everyone's mind is pretty simple. Is this just another classic memory cycle, the kind that booms and then, busts spectacularly? Or has AI fundamentally changed the economics of this company forever?
It is the billion-dollar question. Well, actually, looking at their market cap, it's a multi-hundred-billion-dollar question. And frankly, I'm approaching this with let's say, a healthy dose of skepticism.
As you should.
We just wrapped up 2025 where the stock ran up.
Yeah.
What was it? Approximately 239%.
An incredible run.
That is a parabolic move. Everyone was throwing around this term AI supercycle. But when I look at a chart that's gone vertical, I have to ask, is there any juice left in this squeeze, or are we just helping early investors cash out at the top?
And that is exactly the right skepticism to have.
Yeah.
If you look at history, buying memory stocks after a 200% run, well, it's usually a recipe for disaster.
Exactly.
But the headline data suggests something unprecedented is happening here. I mean, we aren't just looking at a hot stock. We are looking at a company that has reportedly sold out its most advanced product, the silicon that powers the AI revolution, through 2027.
Sold out through 2027. Now, that's a bold claim. We're definitely going to need to verify that. But as usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us, and we appreciate every single one of you tuning in.
So here is the so what for Micron. To understand the opportunity, you kind of have to stop thinking of them as just a chip maker in the traditional sense. You need to view them as the bottleneck for the entire global AI build-out. If you believe that data center expansion is real, if you believe NVIDIA is going to keep selling GPUs, you have to look at Micron.
But the question remains, with the stock trading where it is the market just pricing in absolute perfection?
That's the risk.
Okay, let's unpack this. I want to look at the actual numbers first. It is easy to get swept up in the narrative of AI is changing everything, but the balance sheet, it doesn't lie.
It doesn't.
Do the fundamentals actually back up a 239% rally, or is this all just hype?
They actually do, and in a surprisingly big way. We just got the Q1 fiscal 2026 results back in December, and honestly, they were a blowout.
The blowout.
Micron reported revenue of roughly $13.6 billion. That is up about 57% year over year.
57%. I mean, for a hardware company of that size, that's massive. You usually see those numbers from software startups, not legacy manufacturers.
Exactly. But where's it coming from?
That was my next question. Is it just general demand lifting all boats?
No, and that is the key distinction. It is highly targeted. If you break down that $13.6 billion, the cloud memory segment, which is basically the memory going into those massive AI data centers, was up 100%.
It doubled.
It doubled. And interestingly, even the mobile segment, which, people thought was dead money or just a slow growth commodity, that was up 63%.
So it is firing on multiple cylinders.
Yeah.
But I want to push back on the profitability.
Okay.
Usually in hardware, where you have that much volume, your margins get squeezed. You're rushing to produce. You have overtime costs, shipping expedites, yield issues.
Operational costs.
Are they actually making money on this, or are they just moving units to capture market share?
They are making money hand over fist. This is where the pricing power argument comes in, which is, well, it's rare in the memory world. Gross margins expanded to approximately 57% in Q1.
57.
And if you listen to the guidance, the management team is signaling they're heading toward 65% or even higher. That is driven almost entirely by the scarcity of their high-end AI products. They can dictate the price. Why?
Because nobody else has the supply ready to go.
All right, hold on. I have to jump in with the skeptics check here. Revenue's great, margins are great, but let's look at the cost of doing business. You don't get to $13 billion in revenue without spending a fortune. I'm looking at their CapEx plans.
Yes.
Capital expenditures. They raised the forecast to around $20 billion for fiscal year 26.
It is a massive number, absolutely.
It's a staggering number. $20 billion flowing out the door to build factories and buy equipment. That is a heavy burden.
It is.
We've seen this movie before in the semiconductor space. Companies spend billions building factories at the peak of the cycle, and by the time the factory opens, demand has cooled, and they're left holding the bag.
That's the classic fear.
If the market turns even a little bit, that high burn rate becomes a serious problem.
It's a fair concern. The CapEx intensity, the amount they spend relative to what they make, is incredibly high. But you have to contextualize it with the cash flow.
Even with that massive spending, their adjusted free cash flow was positive in Q1, about $3.9 billion.
So they are self-funding this expansion. They're not going into debt for it.
Exactly. They aren't burning cash reserves or taking on massive debt to do it. They are generating enough cash from operations to pay for the new factories and still have almost $4 billion left over in the quarter.
Wow.
That is a very different financial position than Micron has been in during previous cycles, where they often had to borrow to build.
Okay, so checkbook balances for now. But why do they need to spend $20 billion? What is this moat they're building that requires that much concrete and silicon?
It's all about HBM, high bandwidth memory. This is the secret sauce.
Right.
To understand why this matters, you have to look at the architecture of an AI chip. You can't run an NVIDIA Blackwell GPU without HBM.
Okay, let's pause there and explain HBM. We hear this acronym constantly. How is high bandwidth memory different from, say, the RAM sticks I put in my gaming PC?
That's a great question. Think of your standard PC memory, DDR memory, as a single-story parking lot.
Okay.
It takes up a lot of space, and data has to travel a relatively long distance to get in and out. HBM is like a skyscraper. They literally stack the memory chips on top of each other.
Vertically.
Vertically. They punch holes through the silicon, those are called through silicon vias, or TSVs, and place it right next to the GPU processor.
So the data doesn't have to travel as far.
Exactly. It's physically closer, and the highway is much wider. It's like trying to run a Ferrari on low-grade fuel versus high-octane racing fuel.
Okay, I get it.
If you put standard memory in an AI server, the GPU spends all its time just waiting for data. It just doesn't work. Micron's HBM3E is qualified for those Blackwell GPUs, which are the industry standard right now.
And that's the product you said was sold out?
Precisely. And this is the most critical fundamental point for any investor listening. Micron's HBM supply is sold out for all of 2025.
The whole year.
It is sold out for all of 2026, and the prices are locked in.
So even if the economy wobbles or if there's a slight recession, those orders are effectively spoken for.
Right. I mean, unless the entire global economy collapses and contracts are voided, that revenue is secure. It gives them a level of revenue visibility that commodity memory companies almost never have.
That's a huge deal.
Usually, they are guessing what the price of memory will be next month. Here, they know the price for the next 2 years.
That effectively turns them from a spot market seller into a contract seller.
Yeah.
At least for that part of the business.
Yes.
But there's one more layer to this moat you mentioned in the notes. Geography.
The Made in America angle. This is becoming huge.
This is the geopolitical risk hedge.
Exactly. Micron is the only major U.S.-based memory manufacturer. They have secured $6.4 billion in CHIPS Act grants for fabs in New York, Idaho, and Virginia.
So in a world where geopolitical tension, especially around Taiwan and Asia, is a real risk for supply chains,
having your supply chain on U.S. soil is a safety moat.
It's an insurance policy for their customers.
It is. I mean, competitors like Samsung or SK Hynix are fantastic companies, but they don't have that same domestic U.S. footprint. If you are a U.S. government contractor or a major cloud provider worried about supply chain resilience, you are going to prioritize Micron.
That is a strong fundamental backdrop, I'll admit. But fundamentals are one thing, the stock price is another. You can have a great company and a terrible stock if the price is just too high.
Let's pivot to the price action.
Okay.
Because as we said, we are looking at a chart that's gone vertical.
It's trading near all-time highs, hovering right around that $399 level. And if you look at the structure of the chart, it is textbook bullish.
Yeah.
We are seeing higher highs, higher lows. It is completely broken out of its previous trading ranges.
And it feels different this time, doesn't it? I've watched Micron for a decade. Usually it trades like a commodity stock, very choppy, very tied to the price of RAM. This feels smoother. It does feel different. It's trading in what we call a momentum cohort alongside NVIDIA. The market has stopped treating it like a cyclical commodity company, like a steel mill or a lumber yard, and started treating it like a tech growth stock.
So they're getting a higher multiple.
A much higher multiple. The market's willing to pay a higher PE ratio because they believe the growth is durable.
I want to look at the volume, though, because typically when a stock hits $400 after a 200% run, you expect the big money, the smart money, to start taking profits.
Sure, they sell into strength.
But looking at the indicators, it looks like we are still in an accumulation phase.
That's what the data shows. We aren't seeing massive distribution days where the stock tanks on a high volume.
No, institutional volume has been strong, especially on pullbacks. Every time the stock dips, big money steps in to buy. It suggests the institutions don't think the run is over.
I agree.
It's holding well above the 50-day and 200-day moving averages, which signals a very healthy, strong uptrend.
And that connects perfectly to how the street is feeling about this. Looking at how the street feels about this, the sentiment has shifted dramatically.
How so?
It used to be a battleground stock where analysts fought over it. Now it's becoming a consensus long.
And it's not just feelings, right? There is actual news driving this. Just 2 days ago, January 26th, they had the groundbreaking for that advanced facility in Singapore.
The Singapore facility is huge. It's a clear signal that they are sprinting to add capacity. And it's not just Singapore. You have the construction in New York, the mega fab, and the partnership with PSMC. They are building everywhere.
So why Singapore specifically? We just talked about the U.S. moat. Why go back to Asia?
That's a good question. Singapore is a fantastic neutral ground for semiconductor manufacturing. It has a highly skilled workforce, great IP protection, and it distributes their manufacturing risk globally.
I see.
It's not just about the U.S. and Taiwan. They are building a global network. It allows them to serve the Asian markets more efficiently while keeping the U.S. fabs for, domestic and secure needs.
And the analysts are chasing it. I saw Mizuho raise their target to 390, and some models are pointing even higher.
Consensus estimates are now seeing about 89% revenue growth for fiscal year 26.
89%.
Think about that number. For a company this mature, when you have the entire street revising their numbers up, it creates a tailwind. It's hard to bet against that kind of momentum.
So if we look at the quantitative scoring, where do we land?
The sentiment data is overwhelmingly bullish.
And it's not just Micron in isolation, right? We talk about sector rotation. Is the money flowing into the whole group?
Yes, and that's a great point. If you look at the peers companies like Lam Research or Western Digital, they are also seeing positive sentiment. The whole sector is lifting.
That's a confirmation signal.
It confirms that this isn't just a Micron story, it's an industry-wide acceleration. If only Micron were going up, I'd be worried it was a squeeze. But when the whole sector moves, it's a tide.
And the institutional flow backs that up. Hedge funds and long-only funds have been building positions throughout that entire 239% rally. They aren't just renting the stock.
No, they're owning it. They see the multi-year trajectory.
But let's look at the risks, because I am getting a little nervous with all this bullish talk. My job is to find the hole in the boat before we sail it.
Of course.
And with Micron, there is always a massive hole, historically.
There are definitely risks. We cannot ignore them.
The biggest one for me is simply the cycle. Risk number one. Memory has historically been a brutal business. It's the hog cycle.
The dreaded hog cycle.
Right. Farmers see pork prices are high, so they all breed more pigs. By the time the pigs are grown, the market is flooded, prices crash.
And memory is the same.
It's exactly the same. Prices are high right now. Everyone, Micron, Samsung, SK Hynix is building massive factories. The fear is that by 2027 or 2028, all this new capacity comes online at the exact same time.
That is the classic worry.
If all that supply hits the market at once, do we see a massive crash in prices? Is the market just ignoring the history of oversupply? I mean, we are talking about commodities here. If supply exceeds demand by even 2%, prices can drop 20%.
It is a valid fear. And history would say, yes, that eventually happens. If this were just standard DRAM memory, I would agree with you 100%.
Okay.
If they were just making chips for generic laptops, we would be nearing the top.
We'll get to the rebuttal in a second. I want to layer on risk number two, valuation and expectations.
Right.
The stock is priced for perfection. When you are trading at $399, you have a target on your back.
Yeah.
Any slip, and I mean a tiny slip in the HBM4 roadmap or a small yield issue, could cause a massive sell-off.
That is true. Manufacturing HBM is not easy. It's incredibly complex. If their yield rates drop, meaning they have to throw away more chips because of defects, that hits margins instantly.
And the market has zero tolerance for operational errors at this valuation.
No.
And we did see some light insider selling, some profit-taking in early January. Nothing panic-inducing, but, standard trimming after a run like that.
Sure, they have stock-based compensation, so selling is part of their income. But it is worth noting.
It tells me the executives are happy to cash in some chips at these levels. So knowing all that, knowing the history of the brutal boom-bust cycle, knowing the high valuation and the complexity of the tech, How do you justify staying bullish? Why isn't this the top?
Okay, here's the rebuttal. I argue that this time is structurally different. We are moving from cyclical to secular.
Secular meaning a long-term one-way trend that ignores the business cycle.
Exactly. Look, HBM high bandwidth memory, it's not a commodity. You can't just go buy it off the shelf from anyone. You can't just switch suppliers overnight.
Okay.
It is a highly specialist component specifically for AI. It requires complex integration with the GPU.
So it's more like a custom engine part than just buying generic tires.
That's a great analogy. It's bespoke. And because of that complexity, and because they are sold out through 2027, they have revenue visibility that they have never had before. In a typical cycle, they don't know if they'll sell their inventory in 6 months. Right now, they know their inventory is already sold for the next 2 years. That breaks the traditional boom-bust cycle, at least for the medium term.
That sold-out status is the ultimate security blanket, isn't it?
Yeah.
It's hard to have a bust when you literally cannot make enough product to satisfy the contracts you've already signed.
Exactly. It puts a floor under the financials that just didn't exist in previous cycles. And frankly, the demand for AI compute is not slowing down. The models are getting bigger, not smaller.
More memory.
Larger models need more memory. The trend is exponential.
Okay, we've looked at the explosive growth, the massive spending, the chart breakout, and the looming risk of the cycle. It's time for the verdict. What is the final score?
I am giving Micron Technology a bullish score of 9/10.
And 9 out of 10? That is incredibly high given the run-up we've already seen. You are effectively saying there is still plenty of room to run despite the 239% gain.
It is high, but I think the investment thesis supports it. Micron has successfully transformed. They are no longer just a commodity cyclical stock. They are a secular AI growth story.
And the market is just waking up to that.
It's just waking up to how durable this revenue stream is.
Break down the key drivers for us one last time.
It comes down to 3 things. 1, unmatched pricing power because of the HBM shortage. They are the price makers, not price takers.
Yeah.
2, sold out inventory through 2027, which de-risks the next 2 years of earnings.
Okay.
And 3, massive government backing via the Chia PS Act, which subsidizes their expansion and lowers their effective cost of capital.
So what is the recommendation for the listener?
The target horizon here is a multi-year hold, think 3 to 5 years. We are still in the early innings of the full AI build-out. My recommendation is to buy on dips. Volatility is an opportunity here, not a threat. If it pulls back to the 350 range, that is a gift.
And from the skeptic's chair, I have to say, I am cautiously optimistic. The numbers are undeniable. The cash flow is there to support the spending. And the sold-out contracts provide a safety net that is hard to ignore.
Right.
I still worry about 2028. I think the hog cycle will eventually come for them. But for the next 12, 24 months, the path looks clear.
It really does. It's an exciting time to be watching this sector.
That's it for this stock. Make sure to subscribe, like, and comment to support the channel. We love digging into these deep dives for you, and your support keeps us going.
And here is a final thought for you to chew on. We talked about data centers, but what happens when AI moves to the edge? When your phone and your laptop need this kind of high-performance memory to run local AI models, we aren't just talking about a few thousand data centers anymore. We are talking about billions of consumer devices needing a memory upgrade. That is a whole new demand wave that we haven't even factored into the numbers yet.
Now that is something to think about. Thanks for listening, and we'll see you on the next deep dive.